If gold were just another commodity, it would not attract this level of attention from governments, central banks, and policymakers. Gold is different because it does not simply reflect value, it exposes confidence. And whenever confidence in monetary systems begins to strain, gold becomes inconvenient. That is when warnings appear, not from price charts, but from behavior. When powerful actors begin speaking about gold, reacting to gold, or positioning around gold, it is rarely accidental. It is usually defensive. Right now, those signals are aligning again, and they deserve careful attention, not emotional reaction. The phrase $100,000 gold is not a forecast. It is a warning about scale. It is a reminder of what happens when currency units shrink faster than real value can be contained, and when control becomes more important than transparency. Gold has always existed outside political cycles, which is precisely why political cycles eventually try to pull it back in. When confidence is strong, gold is ignored. When confidence weakens, gold is questioned. And when confidence is at risk, gold is managed. History shows this pattern repeatedly. The issue is never gold itself. The issue is what gold reveals about the system surrounding it. That is why moments of monetary stress often coincide with sudden narratives about regulation, volatility, national interest, or market stability. These narratives are not about protection of investors. They are about protection of perception. In times of rising debt, fiscal imbalance, and monetary expansion, governments face a dilemma. They must maintain confidence in currency while financing obligations that mathematically exceed productive capacity. This requires careful narrative control. Markets can tolerate many things, but they cannot tolerate visible loss of control. Gold threatens that visibility because it does not rely on promises. It does not require belief in policy outcomes. It simply reflects reality over time. That makes it both valuable and problematic. Throughout modern history, whenever gold has begun to move independently of policy expectations, responses have followed. These responses are rarely framed as manipulation. They are framed as stabilization, protection, or reform, but the effect is the same. Intervention increases. The objective is not to eliminate gold's role, but to slow its signal, to dampen the message before it spreads too widely. What makes the current moment different is not the presence of intervention, but the scale of the imbalance behind it. Sovereign debt levels are no longer cyclical. They are structural. Servicing costs are rising into environments where growth is constrained and political tolerance for austerity is limited. This creates pressure on monetary authorities to prioritize system continuity over currency purity. In such environments, gold does not need to be promoted to rise in relevance. It only needs to remain honest. Political cycles add another layer of complexity. Election years, leadership transitions, and geopolitical realignments often coincide with shifts in market messaging. Economic reality does not pause for politics, but political strategy often tries to manage economic perception. This is where gold becomes particularly sensitive. Because gold reacts to long-term credibility, not short-term messaging, it can undermine carefully constructed narratives if left unchecked. The idea that gold prices could reach levels that seem unimaginable today is not rooted in speculation about gold itself. It is rooted in mathematics. Currency units change, purchasing power changes, debt accumulates, systems adapt. Over long periods, nominal prices adjust to reflect these shifts. A number that sounds extreme today often appears ordinary in hindsight when measured against devalued units rather than absolute value. History provides countless examples of this phenomenon across currencies and eras. Warnings about gold are therefore rarely about the metal. They are about what the metal is signaling. When policymakers express concern about volatility, they are often responding to secondary effects. Volatility attracts attention. Attention invites questions. Questions challenge confidence. Confidence is the cornerstone of fiat systems. Maintaining it becomes paramount as structural pressures increase. Silver often follows gold in these cycles, but gold leads. Gold is the benchmark against which monetary credibility is measured. Central banks hold gold not because it yields returns, but because it anchors trust. When central banks accumulate gold quietly, it is a signal. When they discuss gold publicly, it is another. Behavior speaks louder than statements. In environments where trust must be managed carefully, controlling the pace at which gold reflects reality becomes strategically important. This does not require overt suppression. It requires tools. Futures markets, derivatives, leasing arrangements, and coordinated messaging all contribute to shaping price discovery. These mechanisms function smoothly when participation is balanced. They become stressed when physical demand diverges from paper representations. Physical gold does not multiply. Paper claims do. This imbalance can persist for long periods, but it introduces fragility. When confidence in settlement weakens, or when physical delivery becomes a priority, stress emerges. This stress does not always manifest as immediate price explosions. Often it appears as dislocations, premiums, delays, or policy discussions framed as protective measures. The role of political leadership in such moments is often misunderstood. Leaders do not need to directly intervene to influence outcomes. Signals, tone, regulatory emphasis, and institutional alignment can shift market behavior without explicit directives. Markets are highly sensitive to perceived priorities. When stability becomes the dominant priority, assets that signal instability attract scrutiny. Gold's long-term trajectory is therefore shaped less by speculation and more by tolerance. How much truth can the system tolerate before adjustment becomes necessary? When tolerance is high, gold drifts. When tolerance declines, gold tightens. When tolerance breaks, gold reprices. These phases are rarely linear and almost never comfortable. The concept of preparation becomes critical here. Preparation does not mean expecting a specific outcome. It means understanding the environment well enough to respond calmly rather than react impulsively. Those who view gold solely through the lens of price targets often miss its deeper function. Gold is not an instrument of excitement. It is an instrument of continuity. When warnings surface about potential interventions, they should not be interpreted as reasons to fear gold. They should be interpreted as confirmations of relevance. Assets that do not matter are ignored. Assets that matter are managed. Gold has been managed for centuries precisely because it remains relevant across systems. The scale implied by large nominal price discussions is best understood as a reflection of systemic adjustment rather than windfall opportunity. If gold were to be priced dramatically higher in nominal terms, it would not represent sudden wealth creation. It would represent currency recalibration. Purchasing power would already have shifted. The role of gold in such scenarios is preservation, not multiplication. This distinction is critical. Many misunderstand gold because they apply speculative frameworks to a monetary asset. Gold does not behave like equities or technology. It does not generate cash flows or innovation. It preserves value across transitions. That makes it boring in stable times and essential in unstable ones. Political narratives often struggle with this reality because preservation does not fit growth-oriented messaging. Growth requires optimism. Preservation requires honesty. In environments where optimism must be maintained, honesty can appear disruptive. Gold embodies honesty. That is why it attracts attention during periods of strain. Understanding manipulation in this context requires nuance. Manipulation is often imagined as secretive and malicious. In reality, most market influence is institutional and procedural. It is embedded in frameworks, incentives, and priorities. It is rarely about suppressing value permanently. It is about smoothing transitions and managing perception. The risk arises when smoothing delays adjustment too long. Pressure builds beneath the surface. When release finally occurs, it tends to be abrupt. History shows this pattern repeatedly. Gradual imbalances lead to sudden recalibrations. Those recalibrations are rarely controlled. They are responses to accumulated reality. Gold's behavior around such moments is often misunderstood because it does not spike in anticipation. It moves when adjustment begins. By the time headlines focus on gold, the preparatory phase is already over. That is why education matters more than timing. For individuals observing these signals, the question is not whether gold will reach a specific number. The question is whether the monetary environment is becoming more fragile or more resilient. Current indicators suggest fragility is increasing, not catastrophically, but structurally. Structural fragility does not announce itself loudly. It appears in policy dilemmas, in rising debt servicing costs, in trade realignments, in reserve diversification, and in the quiet accumulation of assets that do not depend on promises. These are not speculative observations. They are measurable behaviors. Gold's role within this framework is quiet but persistent. It does not respond to speeches. It responds to outcomes. It does not react to optimism. It reflects balance sheets. Over long periods, it exposes truths that narratives cannot conceal indefinitely. Warnings about gold should therefore be interpreted as signals of transition rather than threats. They indicate that the system is approaching a point where adjustment becomes necessary. Adjustment can take many forms. It can be gradual or abrupt. It can be orderly or chaotic. The determining factor is confidence. Confidence is not binary. It erodes incrementally. Each policy compromise, each emergency measure, each exception weakens it slightly. Gold tracks this erosion over time. When erosion accelerates, gold's relevance increases. Silver often amplifies this dynamic due to its dual role, but gold remains the anchor. Central banks understand this. Institutions understand this. That is why gold remains on balance sheets even in a digital age. It is not nostalgia, it is prudence. The idea that political leadership might seek to influence gold and silver prices should not surprise anyone familiar with monetary history. It has happened before under different names and frameworks. The tools evolve. The objective remains consistent. Preserve confidence, manage transition, avoid panic. For individuals, understanding this dynamic allows for rational positioning, not emotional decisions, not speculative bets. Rational positioning grounded in historical context and system awareness. Gold does not need belief to function. It needs understanding. The coming period is unlikely to provide clarity through headlines. It will provide clarity through behavior. Watch what institutions do, not what they say. Watch how policies are framed, not how they are promoted. Watch how physical markets behave relative to paper ones. These signals are subtle but reliable. Gold's journey through history has never been linear. It has moved through long periods of neglect followed by sudden revaluation. Each revaluation reflected a shift in monetary trust. This cycle has repeated across empires, currencies, and political systems. The names change. The mechanics do not. Preparation in this context means intellectual readiness, understanding gold's function, limitations, and role within a broader strategy. It means resisting the urge to view it as a trade and recognizing it as a tool. Tools are valuable because of when and how they are used, not because of how exciting they are. The discussion around large nominal gold prices should therefore be reframed. It is not about riches. It is about resilience. It is about what happens to currency units over time when obligations exceed productivity, and confidence must be maintained through policy rather than fundamentals. Gold does not create these conditions, it reveals them. Attempts to manage gold's signal are therefore attempts to manage perception. Perception can be influenced temporarily. Reality cannot. As this phase unfolds, patience will be tested. Gold rarely rewards impatience, it rewards perspective. Those who understand this rarely speak in absolutes. They speak in probabilities and preparation. The future does not require certainty to navigate successfully. It requires awareness of cycles, incentives, and signals. Gold has survived every monetary system precisely because it aligns with these realities rather than narratives. Whether or not dramatic numbers ever appear, the warning embedded in this discussion remains valid. When gold becomes inconvenient, it is because truth is becoming uncomfortable. History suggests that discomfort precedes change. This is not a call to action. It is a call to understanding. Understanding the environment, the signals, and the role gold plays within them. Those who understand rarely panic. They prepare quietly and wait. Gold has waited centuries for moments like these. It does not rush, neither should those who seek to understand it.